Hello friends, in this session we shall talk about mutual funds, which is used as one of the best alternatives for investment management. We shall discuss about various aspects related to mutual funds like its setup, the history of mutual funds in India, the cost involved, criteria to choose a fund and benefits associated with mutual funds. Then let's begin with the introduction of mutual funds. In the last few years, numerous innovative offerings have emerged in the financial markets, looking at the growing needs of consumers. The increase in education, knowledge, awareness, social media exposure has all led to a shift in the consumers' minds so far their financial goals are concerned. They are ready to sacrifice a certain present value to secure the uncertainties of future. The principle of having a diversified investment portfolio leads to maximizing returns and minimizing risk. When I say portfolio, I mean a basket of securities where an investor would invest all his savings. Several securities are aimed at pooling little funds from the investors and diverting them, spreading them across varied investment options available in the market. Mutual fund, one such financial innovation, provides a novel way of mobilizing savings from little investors and allowing them to participate in equity of industrial organizations with a relatively low risk. Hence, it is the most suitable form of investment for the common man as it offers an opportunity to invest in a diversified as well as a professionally managed basket of securities with low cost. Let's understand the definition now, friends. According to Association of Mutual Funds in India, a mutual fund is a trust that pools the savings of number of investors who share a common financial goal. Anybody with an investable surplus of a little of few thousand rupees can invest in mutual funds. The investors buy units of a particular scheme that has a defined investment objective and a strategy. Now, understanding the Sebi regulations definition, mutual funds means a fund established in the form of a trust to raise monies from public or a section of public to invest in securities in accordance with the regulations. Now, friends, before we go ahead, it is important to understand the history of mutual funds in India. The mutual fund industry in India started in 1963 with the formation of Unit Trust of India. It was the initiative of the Government of India and the Reserve Bank of India. The history can be broadly divided into four distinct phases. The first phase began in 1964 and lasted till 1987. The UTI worked under the regulatory and administrative control of the RBI. In 1978, it was delinked from RBI and the Industrial Development Bank of India took control of the same. By the end of 1988, UTI had Rs 6,700 crores of assets under management. The second phase began in 1987 and lasted till 1993. This phase marked the entry of non-UTI funds. The public sector banks, Life Insurance Corporation, General Insurance Corporation and State Bank of India were the first to enter the mutual funds market. By the end of this phase, the industry had assets of close to 47,000 crores under management. The third phase began in 1993 and lasted for a decade. This phase marked the entry of private sector funds. Also in 1993, the Mutual Funds Regulations Act came into being. Later in 1996, many revisions were made. All the mutual funds except UTI were to be registered and governed under this act. The industry now functions under the Sebi Mutual Fund Regulation Act 1996. By the end of January 2003, there were 33 mutual funds with assets under management of close to 1,21,800 crores. The fourth phase began in February 2003. In this month, the UTI was bifurcated into two separate entities. One which represented the US 64 scheme, which was the first scheme launched by UTI. It was not under the purview of mutual fund regulation. And the second one was sponsored by the State Bank of India, Punjab National Bank, Bank of Baroda and Life Insurance Corporation. This was registered under the Mutual Fund Regulations Act. This phase also characterized the era of growth and consolidation. By this time, the mutual fund industry had grabbed a lot of attention from the investors. So, Sebi came into action. Now, let's understand the role of Sebi, that is the Securities Exchange Board of India. It is initially promoted for the protection of investor rights. In the year 1992, the Sebi Act was passed. The objectives of Sebi are to protect the interest of the investors in securities, to promote the development and regulation of securities market, to notify the regulations in mutual funds, to cover all the mutual funds promoted by public sector, private sector and foreign players under the same set of regulations. So, basically, the mutual fund industry is a highly regulated industry and hence is a very safe zone for investment. Also, in 1995, the Association of Mutual Funds of India was established to promote healthy and ethical marketing practices in the Indian mutual fund industry. Now, dear friends, let's talk about how a mutual fund is set up. The mutual fund is set up in the form of a trust, which has a sponsor, trustees, asset management company and a custodian. It is very important to understand the role of various parties to mutual funds. We begin with the sponsor. The sponsor acts as a promoter of the company and establishes the mutual fund. It gets it registered with the Sebi, forms a trust, appoints the board of trustees and contributes at least 40% of the net worth of asset management company. Now, we shall talk about the trustees. The trustees hold the property on behalf of unit holders. The trustees appoint the asset management company and ensure that all the activities are under the Sebi regulations. They appoint the custodian of the fund and are also accountable for funds and property of respective investors. The asset management company takes care of flotation of various securities according to investor requirements. They manage the mutual funds according to Sebi regulations, decide on the fees to be charged to carry out asset management activities. Custodian. The custodian holds the fund securities in safekeeping, settles securities transactions of the fund, collects interest and dividends paid on securities, records information on stock splits and other corporate actions. Distributors and agents. They sell the unit on behalf of the fund. They comprise of banks, non-banking financial companies and other distribution companies as well as individuals. Banker. The banker, as we all know, facilitates the financial transactions and provides remittance facilities. Registrars and transfer agents. They maintain the records of unit holders, accounts and transactions. They also receive funds from the investing public and allot units of the scheme. They disburse the funds to the unit holders, communicate with the unit holders and provide all kinds of unit holder services. Friends, let's move ahead to understand the classification of mutual fund schemes. Basically, the mutual fund schemes are divided into two types: open-ended schemes and close-ended schemes. However, looking to the demands of today's generation, many hybrid options are available in the market. Let's get into the open-ended schemes. The open-ended schemes do not have a fixed maturity period. They allow the investors to sell or buy at any point in time at a price linked to the net asset value, which is called NAV. It is available for subscription and repurchase on a continuous basis. The key advantage of open-ended scheme is liquidity. Now friends, let's understand various types of open-ended schemes. Number 1, the debt or income funds. As the name suggests, debt funds provide regular and steady income to the investors. They invest in debt instruments issued by various government companies, private sector, banks and financial institutions. The debt funds are less risky. One such funds are called gilt funds. These funds invest only in government securities, so there is no default risk involved. The second one is money market or liquid funds. The money market funds are used to park surplus funds in short-term instruments and avail the benefit of liquidity, preservation of capital and moderate income. They invest in instruments like treasury bills, certificate of deposits, commercial papers and government securities. There are less fluctuation in returns as compared to other securities so far money market funds are concerned. Third one is the equity or the growth fund. Again, as the name suggests, the money is invested in equity shares of various companies. This provides capital appreciation as well as high level of current income through dividends issued by such companies. One such type of equity scheme is called the index scheme. The index schemes replicate the portfolio of benchmark indices such as the BSE Sensex and the NSE Nifty. NAV of such schemes would fluctuate in accordance with the index, though not exactly by the same percentage, but due to some factors called the tracking error. Now, what's the tracking error? It is the difference between a portfolio's return and the benchmark index, which it was meant to beat. The next in line is sectoral schemes. The investment is only in a particular sector, say for example, information technology, pharmaceuticals, automobiles, etc. The returns are higher, but it is riskier than diversified funds. The next is the tax saving scheme. Such schemes offer tax rebate to the investors. For example, the equity linked savings scheme, popularly known as ELSS, the pension schemes, etc. Now we have the balance funds to understand. They provide growth and regular income, such as the schemes investing both in equities and fixed income securities, in the proportion indicated in the offer documents. This is ideal for cautiously aggressive investors. Now friends, we understand the close-ended schemes. The close-ended schemes have a fixed maturity of say 5 to 15 years. It makes only a one-time sale of a fixed number of units during the initial offer period. They are open for subscription only during the launch period. They disclose the NAV on weekly basis. Though some schemes provide an exit route to investors by giving an option of selling back the units to mutual funds through periodic repurchase at NAV related prices which are listed on the stock exchanges. The first is the capital protection plan. It safeguards the principal amount while trying to deliver reasonable returns. Such plans invest in high quality fixed income securities with marginal exposure to equities, and they mature along the maturity period of the scheme. The second is the fixed maturity plans. They are called FMPs. The investment is in debt instruments which again mature in line with the maturity of the scheme, thereby earning the interest component of the securities in the portfolio. They are passively managed, so the expenses charged are low. As I mentioned, we have hybrid options available in the market. So next in line is the interval scheme. The interval scheme is a combination of open and close-ended schemes. It allows the investors to trade the units at predefined intervals. We have a new scheme called the fund of fund schemes. These schemes collect money from the people and invest in other mutual funds and reduce risk by diversification. The cost of funds are higher, but they do offer tax rebates. Now friends, let's understand the cost of investing in a mutual fund. There are basically 4 types of costs. The first one is the initial issue expenses. They include items during the initial issue of the mutual funds like brokerage, commission, marketing cost, advertising cost, printing and distribution cost. Though a proposal to disallow these expenses is under consideration. The next is the entry load. It includes the load imposed when the units are purchased. It is added to the NAV at the time of allotment. The schemes that have an entry load are called load funds, and those which do not are called no load funds. The exit load. This includes the load which is imposed when the units are sold back to the mutual funds. Its aim basically is to deter the investors from withdrawing from mutual funds. It varies from 0 to 3%. The other costs are the annual recurring expenses, or shall we say the maintenance expenses. It includes the investment management and the advisory fees charged by the asset management companies, and operating expenses like the marketing and the selling expenses. It is around 1.25% of the net assets up to rupees 100 crores and 1% above rupees 100 crores. The above costs are visible, but there is a large invisible cost which is overlooked, and that is called the portfolio transaction cost. When a mutual fund buys or sells securities, it incurs commission as well as market impact costs. They depend on the rate of portfolio turnover and the degree of liquidity and the marketability of securities included in the portfolio. Hence, the investors need to be aware of the potential impact of such costs on investment returns. So, friends, we should understand the criteria to choose a fund. Let's look into the details. The first one is the track record of the fund manager. It can also be called as the creditworthiness of the fund manager. The fund manager should have a good track record at efficient fund management to create confidence in the minds of the investors. The second is to understand the quality of the portfolio. It considers the risk and return of the portfolio. The mutual fund schemes are periodically evaluated by various organizations such as the Economic Times, CRISIL, which is Credit Rating and Information Services of India Limited, who give ratings or grades to the performance of various mutual fund schemes and thus guide the investors as to choose or not to choose a particular fund. Then we shall understand the number of retail investors and their average holding size. Small funds could be in trouble if the investors quit together for some or the other market factor. The size of the funds. The bigger funds seem to have a better access to opportunities as compared to the smaller funds. Weighted average maturity. Longer maturities hedge against the downward movements in interest rates, but it could lose out on the short-term upswings in the interest rates. Shorter maturities, though, protect against rising interest rates. The dividend frequency. The investors who look for regular returns would prefer tax-free dividends, but it could though hinder capital growth as well. The offer document and the key information memorandum. This is the most important source of information for investors. The key information memorandum is the abridged version of the offer document. It is to be compulsorily made available along with the application form. It contains the preliminary information of the fund and the scheme, the details of the scheme, the investor rights, income, expenses associated with existing schemes. The main attributes of the scheme are its type, its objective, the investment pattern, fees, expenses, liquidity conditions, accounting and valuation, and investment restrictions. The asset management company prepares the offer document and the key information memorandum and is responsible for all the information contained in it. And the trustees approve the contents of both the offer document and the key information memorandum. Now, friends, we should understand the tax aspects of a mutual fund investment scheme. First, at the fund level. The entire income of a mutual fund registered with Sebi is exempt from income tax in accordance with the provision of Section 10(23)(d) of the Income Tax Act 1961. It is liable to pay securities transaction tax on its purchase and sale of equity shares, units of equity oriented funds, derivatives as well as dividend distribution tax. Now the tax implications at the unit holders level. The dividend received from mutual funds is tax exempt in the hands of the unit holders. Long-term capital gains arising from the sale of equity oriented funds are exempt from income tax provided the securities transaction tax is charged on the sale by the mutual fund. The short-term capital gains arising from the transfer of units of an equity oriented scheme are taxed at the rate of 15% plus applicable surcharge and cess, provided the securities transaction tax is charged on sale by the mutual fund. Long-term or short-term gains from sale of units of mutual fund schemes other than the equity oriented schemes are taxed in the hands of unit holders. Now friends, after understanding the costs and the criteria to choose a fund, let's understand the benefit of mutual fund investments. Number 1, they are professionally managed. The funds are managed by professionally skilled managers with a backup of a strong research team. Number 2 is diversification. Mutual funds offer diversification to reduce risk so as to maximize returns. Number 3, convenient administration. All the services are offered in demat form and hence time and delays are taken care of. Number 4, low cost of management. The costs are low because they cannot exceed the prescribed limits of Sebi. Number 5 is liquidity. In case of open-ended schemes, liquidity is provided by the direct sale or repurchase by mutual funds, and in case of close-ended schemes, it is provided by listing on stock exchanges. Number 6 is transparency. The net asset values are calculated on daily basis. The performance reports are provided half-yearly and hence mutual fund schemes are transparent. Number 7, highly regulated. All the schemes of mutual funds come under the strict purview of Sebi regulations, thus protecting the interest of the investors. Number 8 is small investments. Any investor with a few thousand rupees can invest in mutual funds. Number 9, tax advantages. As discussed earlier, mutual funds are tax exempt entities. No taxes are paid on dividends and interest income as well as long-term capital gains. The dividends distributed by the mutual funds are also tax-free for the recipients. Number 10, other benefits. The other benefits include easy switchover from one scheme to another. Also, regular withdrawal and systematic investment plans are available to the investors. Now friends, let's summarize the whole session. This schedule explained the evolution of mutual funds as a newer and a safer investment option for cautious investors. It is necessary for a student to know how the fund managers operate and deal with public money. So there was some light thrown on the role and functions of various parties to mutual funds. The classification of mutual funds elucidates the need of varied and hybrid products introduced in the market to cater to all types of investors. Also, the growth in the overall investment in this sector and the benefits attached to it explains its growing popularity. As a rule, do not put all your eggs in one basket. It also explains the costs and the limitations of the said tool for investment. Thank you friends. Hope you now have sufficient information on mutual funds.